Could you comment on how this particular inflationary period ranks among previous such periods in the United States, like the 1970s and 1980s? And what can American businesses and citizens do to reduce the negative impacts that inflation brings about?
Well, we've sort of attacked what you do yourself. And you develop skills that people are willing to pay for in the future, regardless of what the unit of exchange is. But in terms of inflation in our own businesses, it's extraordinary how much we've seen. I think you interviewed Herb Blumpkin at the Furniture Mart, and for 2 years, the prices have just kept coming in higher for these things.
2024 has started in an era of soaring inflation, hitting a notable 3.1% as of last November. But what if I told you there's a way not just to survive, but thrive in this economic climate? When you invest like Warren Buffett, bad economic times become opportunities. In the next few minutes, we're going into strategies that go beyond the ordinary. We're not just talking about beating inflation, we're exploring how to make it work for you. From the secrets of dividend-rich stocks to the dangers of common investment traps, we're uncovering the strategies that have made Buffett a legend. Surprisingly, these strategies are not just for 2024. They're timeless tactics proven to withstand any economic condition. So are you ready to turn the tables on inflation? Let's get started.
Are you seeing signs of inflation beginning to increase?
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. I mean, it's not.
When you look at the high inflation of 2024, you can see a very important financial truth. Keeping money in savings accounts can be like letting money slowly leak out. One of the biggest names in investing, Warren Buffett, has a clear view on this. Let us look at why putting your money in a savings account might not be as safe as it seems during times of high inflation. Buffett has long cautioned against the hidden cost of holding cash in savings accounts during periods of high inflation. The reason is simple. The interest earned on savings accounts often fails to keep pace with the rate of inflation. For example, with the inflation rate at 3.1% at the end of 2023, any interest rate on savings that falls below this effectively means you're losing money. Your cash balance might be stable, but its purchasing power is eroding. This scenario is what Buffett refers to as a wealth tax. While your nominal cash balance remains unchanged, the real value, what your money can actually buy, decreases over time. In an inflationary period, the gap between the interest earned and the inflation rate is where your wealth silently diminishes. Buffett's advice in such a scenario is to look beyond traditional savings. He encourages investors to consider assets that have the potential to outpace inflation. This could mean investing in stocks, particularly those in companies with strong fundamentals and the ability to maintain profitability during inflationary times. These companies often have the pricing power to pass on increased costs to consumers, thereby protecting their revenues and, by extension, your investment. Another strategy Buffett advocates is diversifying into assets that historically hold their value or even appreciate during inflation. This could include real estate, certain commodities, or even inflation-protected securities. The idea is to have your money in places where it's not just sitting idly, but actively working to counteract the effects of inflation. So, Warren Buffett's approach during high inflation is clear. Keeping cash in savings accounts can be a losing strategy. Instead, he advises a proactive approach, seeking out investment opportunities that can not only withstand the pressures of inflation, but potentially thrive in such conditions. It's about being strategic with your cash, ensuring it retains, if not grows, its value in real terms.
Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings.
There is a difference between good investments and bad investments in an inflationary climate like the one we're seeing in 2024. With decades of experience as an investor, Warren Buffett has talked a lot about the risks of certain types of investments during these times. In this section, we'll explore the types of investments that are best avoided during periods of high inflation, using examples and studies to illustrate these points. Firstly, Buffett warns against investing in fixed income securities with long maturities. During inflation, the interest rates tend to rise, and the value of existing bonds with lower rates decreases. A study by the National Bureau of Economic Research supports this, showing that long-term bonds have historically underperformed during inflationary periods. For instance, during the high inflation of the 1970s, long-term government bonds saw a significant decline in real value. Another category to be cautious about is speculative assets. In times of economic uncertainty, it's tempting to chase high returns on speculative investments like certain cryptocurrencies or highly volatile stocks. However, Buffett advises against this. He emphasizes the importance of investing in assets with intrinsic value, those that generate consistent earnings or have real worth. A report by J.P. Morgan Asset Management highlights that during inflationary periods, speculative assets can be particularly risky due to their inherent volatility and lack of underlying value. Buffett also cautions against overinvesting in commodities. While commodities like gold are often considered a hedge against inflation, they don't produce any income or dividends. Their value is purely speculative, based on what the next buyer is willing to pay. A study by Duke University found that over the long term, commodities have not significantly outperformed inflation. Buffett suggests that it's better to own productive assets, those that generate income or have potential for growth. Real estate investments can be tricky during inflation. While property values may rise with inflation, the costs associated with owning and maintaining real estate can also increase. A Harvard Business Review article points out that real estate investments require careful analysis of the property's income-generating potential and the impact of rising costs. Buffett advises investors to focus on properties that can maintain profitability even as expenses rise. Finally, Buffett warns against businesses with high fixed costs and little pricing power. These businesses struggle to pass on increased costs to consumers, squeezing their profit margins. A study by McKinsey & Company found that companies and industries with low pricing power underperform during inflationary periods. Buffett recommends focusing on companies with strong brands and pricing power, as they are better positioned to navigate inflation. In simple words, during periods of high inflation, Warren Buffett advises avoiding investments in long-term fixed income securities, speculative assets, non-income producing commodities, and businesses with high fixed costs and low pricing power. Instead, he advocates for investments in assets with intrinsic value, income-generating potential, and the ability to adapt to changing economic conditions. By following these guidelines, investors can navigate the inflationary landscape more effectively and protect their wealth. We are facing economic problems in 2024. But there is one practical strategy that stands out as being very useful in any year when the economy goes down. This approach, endorsed by investment gurus like Warren Buffett, is not only simple, but also profoundly impactful in securing financial growth. Let's look at this key strategy that can help you make money and thrive even in tough economic times. The strategy is to diversify into dividend-paying stocks. In an uncertain economy, one of the smartest moves you can make is to invest in companies that pay regular dividends. Dividend-paying stocks offer a dual advantage. They provide a steady income stream and have the potential for capital appreciation. Here's why this strategy is effective. Number 1, steady income stream. Dividends are payments made by companies to their shareholders out of their profits. In times of economic downturn, having a consistent income stream from dividends can be a financial lifeline. It provides a cushion against market volatility and can help sustain your finances when other sources of income might be under pressure. Number 2, potential for capital appreciation. Besides regular income, dividend-paying stocks also offer the potential for capital growth. Companies that consistently pay dividends are often well-established and financially stable. Investing in these companies can lead to capital appreciation over time as the value of the stock increases. Number 3, the compounding effect. Reinvesting the dividends you receive can lead to compounding growth. By using your dividends to purchase more shares, you increase your potential future dividend earnings, creating a snowball effect that can significantly boost your investment over time. Number 4, risk reduction. Diversifying your portfolio with dividend-paying stocks can also help cut down the risk. These stocks are typically less volatile than non-dividend-paying stocks, providing a more stable investment option during economic downturns. A study by Hartford Funds showed that over a 50-year period, dividends contributed to approximately 40% of the total equity market returns. This highlights the significant role that dividend-paying stocks can play in an investment strategy, especially during tough economic times. In short, investing in dividend-paying stocks is a practical and effective strategy to make money in 2024 or any other year with economic challenges. It offers a blend of income generation, potential for capital growth, and risk lowering, making it a wise choice for investors looking to navigate uncertain economic waters. If you are looking at stocks that pay dividends in 2024, Warren Buffett's picks can help you. Let's explore some of the top dividend stocks that Buffett is focusing on this year, diving into their historical performance, reasons for their selection, and future potential. Number 1 is Visa. Visa has been a standout in Buffett's portfolio, known for its formidable economic moat. As the leading global payments technology company, Visa has shown resilience in various economic conditions. Its consistent dividend growth is backed by a robust business model that benefits from the increasing shift towards digital payments. With a history of steady dividend increases and a strong position in the global market, Visa is poised for continued success. Number 2, American Express. Another gem in Buffett's collection, American Express, has a long-standing history of dividend payments. Known for its premium branding and customer loyalty, AXP has demonstrated an impressive ability to maintain and grow its dividend payouts. Its unique business model, focusing on high-spending cardholders and business services, provides a stable income stream, making it a reliable choice for dividend investors. Number 3, D.R. Horton. D.R. Horton, a leading home construction company, is predicted to be one of Buffett's top dividend picks for 2024. Benefiting from the continuing growth in the U.S. housing market, DHI has shown the ability to increase its dividends consistently. Its strategic focus on affordable and entry-level homes positions it well to capitalize on the housing demand, making it an attractive option for dividend-seeking investors. And number 4 is Coca-Cola. A longtime favorite of Buffett, Coca-Cola has been a consistent dividend payer for decades. Its global brand strength, diversified product portfolio, and ability to adapt to changing consumer trends has contributed to its steady financial performance. Coca-Cola's commitment to maintaining and growing its dividends, even in challenging economic times, underscores its appeal as a dividend investment. Each of these companies has demonstrated a strong track record of financial stability and dividend growth. Their ability to navigate economic cycles, coupled with their strong market positions, makes them ideal candidates for dividend investment in 2024 and beyond. As Buffett often emphasizes, investing in companies with a solid history of dividend payments and the potential for future growth is a strategy that can yield fruitful returns, especially in uncertain economic times. As we conclude our exploration of Warren Buffett's investment strategies for thriving in 2024's inflationary environment and beyond, it's clear that the wisdom of this investment guru remains as relevant as ever. From knowing the risks of keeping cash in savings during times of high inflation to picking strong stocks that pay dividends, Buffett's approach can help you confidently handle economic uncertainty. Now we turn to you, viewers. What are your thoughts on these strategies? Are there any dividend stocks you're eyeing in 2024 that align with Buffett's principles? Share your insights and investment plans in the comments below. Your input not only enriches our discussion, but also helps build a community of informed investors. And if you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Your engagement helps us bring more valuable investment insights to you. Remember, investing is not just about following trends. It's about making informed decisions based on sound principles and adapting to the ever-changing economic landscape. Let's continue this journey together, learning, growing, and investing wisely. Thank you for watching, and until next time, keep investing smartly.